Listed transactions are at the very top of the IRS enforcement ladder. This is not routine tax planning. This is not aggressive structuring. A listed transaction is a tax shelter or a tax strategy that the IRS has specifically identified as a tax avoidance transaction. And if your transaction is substantially similar to one of the transactions that's listed, you're required by law to disclose it. Failure to do so can trigger draconian penalties, extended statutes, and in the wrong fact pattern, criminal tax investigation and prosecution risk. So what does substantially similar really mean? Taxpayers, and more often their advisors, often assume they can avoid disclosure by changing the name of the strategy, the entities involved, the jurisdictions involved, and the paperwork structure. But the disclosure rules, they don't focus on marketing labels. They focus on the underlying tax structure of the strategy, the expected tax treatment of the strategy, the expected tax benefit. If the economic effect mirrors a listed transaction, disclosure is required, period. Whether you or your advisor call it something else is completely irrelevant. And once the IRS suspects there's been undisclosed participation in a tax shelter, your exposure posture changes immediately. The primary vehicle is found in Form 8886. It's a reportable transaction disclosure statement. Generally, the rules require you to attach a Form 886 to your tax return. You also need to send a copy to the IRS Office of Tax Shelter Analysis. You also have to file it in the manner and timing specified in the document. Taxpayers and preparers and advisors create disclosure failures in predictable ways. Never filing the form, filing it incompletely, omitting related entities, failure to disclose fee arrangements, relying on entity-level reporting alone, forgetting to send the required copy. And many assume that if the entity is disclosing, they personally don't need to do so. That assumption often fails. Disclosure duties can apply at multiple levels. So why does non-disclosure change your entire case? Non-disclosure triggers immediate civil penalty exposure, draconian penalties. Those are found under Internal Revenue Code Section 6707A. That authorizes significant penalties for failing to disclose a listed transaction. This is strict liability here. Even without proof of your negligence or willfulness, don't file the form, that's all they need. And rescission is severely limited for listed transactions. But the larger issue here is the leverage. If you claimed a substantial tax benefit and failed to disclose it, the IRS can treat that omission as a criminal tax credibility marker. The case can shift from technical tax treatment to an inquiry whether you had criminal tax intent. It also creates statute of limitation problems. Disclosure failures also affect timing. If you fail to disclose a listed transaction properly, the statute of limitations for assessing on the tax attributes of that transaction remain open indefinitely. 20 years in the past, I shit you not. It does not expire until 1 year after you've made the proper disclosure. That means what you believe was closed may not be closed, and multi-year exposure can develop quickly. So when do disclosure failures create criminal tax risk? A disclosure failure does not automatically equal a tax crime. The government still must prove that you were willful and there was affirmative conduct. However, criminal tax exposure increases when the record shows things like there were secrecy devices involved, there was nominee ownership, there were layered entities with no business purpose whatsoever, fabricated support, backdated or altered records, false explanations, and most importantly, improvised narratives after IRS contact has begun. Listed transaction cases often become criminal tax intent cases based on conduct, both of you or your advisor, after contact begins. Improvised explanations create evidence. Reconstructed records create contradictions. Unprotected communications, especially by the original advisor or promoter, they can create criminal tax admissions without even you knowing it. So how do you respond safely if you suspect your transaction may be listed or substantially similar to a listed transaction? Whatever you do, do not improvise. You need a disciplined approach, which is going to require determining whether the transaction meets the listed or substantially similar standard, mapping every structured step to verifiable documentation, evaluating corrective disclosure options and timing, and most importantly, controlling communications through privileged counsel. To that end, a CPA alone or anybody that isn't an attorney cannot protect communications. If criminal risk develops, you must align civil exposure and criminal tax screening from the outset. Whatever you do, do not let the person you reach out to regarding your exposure of illicit transaction invariably become government witness number one against you because they lacked attorney-client privilege and all your communication can be subpoenaed. So in closing, disclosure is a strategic inflection point. Illicit transactions rarely stay narrow. The IRS builds the case from objective documents, promoter materials, subscription agreements, wire records, partnership books, emails, cross-year comparisons. Once the government frames your non-disclosure as income tax evasion, the risk in your case expands exponentially. If you participated in a transaction the IRS could treat as listed or substantially similar, and you did not file a timely and complete Form 8886, you need a disciplined defense strategy immediately from the get-go. At the tax law offices of David W. Klossing, our dual-licensed tax attorneys and CPAs routinely handle high-risk civil and criminal tax matters. We use privilege-centered planning for the defense. Call 1-800-681-1295 or visit klossing-associates.com to request a reduced rate confidential initial consultation today. Early dual license attorney CPA representation often determines whether a disclosure issue remains civil or escalates into a criminal tax investigation and prosecution. Call us today, you won't regret it. Dave Klossing, Tax Attorney CPA.